In a recent report, the African Peer Review Mechanism strongly criticized international credit rating agencies for downgrading most African countries, resulting in increasingly high borrowing costs. Credit ratings play a crucial role in determining a country's borrowing costs. The higher the rating, the more reliable the country is perceived to be, and the more willing investors are to lend at lower interest rates. On the other hand, a low rating can lead to high borrowing costs in Africa, which can hinder economic growth. Investors see higher-rated countries as less risky and are therefore more willing to lend to them at favorable rates. Subjective credit ratings increase the cost of servicing debt, put countries in difficult positions of having to choose between repaying the debt and meeting the needs of their people. High public debt can also crowd out public investment, increase budgetary pressures, reduce social spending, and limit the government's ability to implement reforms. Rating agencies such as Moody's, Fitch, Standard & Poor's use a combination of quantitative and qualitative analysis to determine the country's creditworthiness. They look at economic indicators such as the GDP growth, inflation, and the debt-GDP ratio, as well as the country's political and social context to assess its creditworthiness. African experts met in Washington in April to discuss the impacts of credit ratings on financing development in Africa. They called for a review of international financing systems, particularly for African countries where rating standards seem less appropriate. In their review, it is essential to take into account the specific characteristics and real progress of African countries when assessing their creditworthiness. A more balanced and objective rating would promote more affordable financing for Africa's development, thereby improving its economic prospects and growth potential.